This is the Daily Market Rundown, live from the Tradelo trading floor. It's July the 7th, some highlights from today's show. Tariff letters are to set the tone for the week. OPEC contemplates or completes oil output hikes, and US rates to drive the dollar higher. Good day traders, and welcome back to another very lively week. Hopefully you all had a good long weekend break. Happy 4th of July. Let's get stuck straight into it. I think the session of course has started off quite upbeat. There's been quite a lot of news flow over the course of the weekend. There's a lot of backwards and forwards, and there's quite a few little moving parts. So the best thing to do is let's get stuck straight into topic number one. Now, of course, over the weekend it was all about the tariff situation. The big beautiful bills, of course, passed. We know the war between Iran and Israel is completed, and ultimately now the markets are focusing on the tariff situation because we do have the 90-day deadline coming in view, of course, on the 9th of July. Now, that kind of doesn't matter anymore. The 9th of July was the end of the 90-day extension from the Liberation Day tariffs that started back in April. But the reality of the situation is that that deadline actually just no longer matters. Okay, now what we have heard, let's try and sum it up. What we do know to be true is that ultimately the administration is today going to send out letters to a number of key trade partners, and in that letter there will be a number, a tariff number that will be applied to certain countries should they not agree to a deal by August the 1st. Okay, so in other words, the first thing to know is that that 90-day deadline has now shifted to the 1st of August. That's the important thing to note. Okay, why is this positive? Well, because again, it highlights the administration's strategy, which is we are going to escalate to de-escalate. We are going to say lots of shouty, nasty little things. We're going to put some crazy numbers on a board, but ultimately we're doing it because we want to force a deal over the line. Okay, but ultimately we've just been given another, call it 4 weeks to ultimately negotiate. That's the first thing to take away from it. And that's why the market, for lack of a better word, doesn't really give two hoots about the current situation in terms of tariffs. Okay. The second thing to note is, of course, even that 1st of August deadline is now called into question because Hassett has come out and effectively said that for countries that are negotiating with good faith, we can give them some more time beyond the August deadline. So the point is it's a bit like what Trump said perhaps a couple of weeks ago, where he said, look, we can do whatever we want, we can do it however we want. That's the point to all of this, which is they are not going to want to frighten the markets. What they will do is try and extrapolate some leverage via, high tariff numbers in a letter. They'll try and get as much concessions as possible. But ultimately, whatever you hear in the letters later on today, the end point 6 months from now will be substantially lower than that. And that's what you have to know as a trader. Okay, because most likely what you're going to get out today is you're going to get some sort of red headlines on the Bloomberg. It's going to say lots of crazy things like, some countries are going to get really very difficult reciprocal type tariffs. The markets will perhaps stage a little bit of a risk off, but the reality is the market will look straight through it. Why? Well, because like I said, 6 months from now, then the actual tariff rates that will be applied will be substantially low. Okay, and this is what the market's learned all year, which is look through the bad news, look through the bluster and the rhetoric, focus on ultimately what the end point is, which is substantially lower tariffs. Okay, now let's get into some of the more interesting parts, because we are going to find out about these letters today. There is going to be a little bit of a shock and awe. This is actually from Bloomberg. It's a very nice summary of where each country kind of stands with the US. Now, we know we've got a deal from the UK. Well, we can call it a deal, but ultimately they got exactly what they had on April the 1st, which was a 10% tariff. Okay, we can see Vietnam, of course, is the only other sort of economy that had a very high reciprocal tariff of around 40%, and ultimately their tariff now, their applied tariff is 20%. Okay, so in other words, they didn't get the baseline 10%, they didn't get the worst case scenario from April, which is 40%, they got smack bang in the middle, which is 20%. Okay, now of course we know that Vietnam is not a small trading partner of the US. They do around 2.7% of US's total imports. So they're not small, and I think they're a good base case in which we can start to get an idea of exactly how this is going to play out, which is no one in terms of the big countries are going to get that lower rate like the UK got. Why? Well, because we know, for example, that the EU has got a significant trade imbalance with the US. The EU is not going to just roll over and give the US everything. So the way it's going to turn out is most likely the EU is going to get something like a 20% tariff, and then fine, there'll be all sorts of, we're going to hit you with this, we're going to hit you with that. There'll be all sorts of quotas given to the EU. The point is that the effective tariff rate's not going to be 10%, it's not going to be 50%, but it is going to be higher than 10%, and it is going to be lower than 50%. Okay. Now we don't know what that number is, but we do know that letters sent out today are probably going to showcase the reciprocal tariff leaning towards the higher end of things as opposed to the lower end of things. Why? Well, because we know the Trump administration wants to extrapolate some form of concession. Okay. And again, this strategy is very, very clear. It's the strategy that's been applied all year. So don't get sucked into the way the markets move on it, because the reality is that they'll fade away very, very quickly. Okay. Now that you can go and read through, obviously, do focus on the EU. I think that's going to be a key one to watch out for, as well as we do want to focus on India. We know there's been some backwards and forwards there, and we've been told things are going very well and then not so well. The same with the EU. Okay, the general narrative now is things are going very well with the EU. They have got some form of a deal, but we don't yet know what that tariff's going to be like. Okay, but all of these countries matter. All of them are relatively large. The other key ones to focus on, of course, are Japan and South Korea. They are also major trading partners, as well as, of course, Mexico and Canada. Okay, the point is there's a lot of information that we are going to hear about over the next couple of days, but don't forget, and this is the key, we have got an extension to the 1st of August, and then we've got an extension of the extension so long as countries are negotiating in good faith. Okay, the point is that we'll keep having these extensions, and ultimately the marginal tariff rate is going to tend towards the lower end, which is that 10% as opposed to the higher end. That's all you need to know, and that's what this is illustrating. Okay, right now, the current general consensus that Wall Street thinks is that the marginal tariff rate's around 12.5%. Don't forget, coming into this year, we had a 2.5% marginal rate in the US, so it's roughly 10% higher. Is that problematic? No, perhaps not. Of course, we've been talking about this a number of times on the show. It all depends on who absorbs that tariff. Is it absorbed by the seller? Is it absorbed by the importer? Is it absorbed by the consumer? We just don't know. Are all three of them absorbing it? We just don't know. Okay, what we will know is when we get the PPI data out and the CPI data out, then we'll start to understand who's absorbing it. There was also an article out this weekend from one of the Fed central bankers, I think it was Barking, talking about how different companies are actually passing on the costs. But again, we just don't know. The Fed's general assumption is that a high enough amount of the tariff is going to be consumed by the consumer. Therefore, it makes absolute sense for them to be prudent and keep rates where they are now, because there is a little bit of an inflation bump coming as soon as this month. Okay, and that's why all eyes will be on the inflation print next week. But until then, we just don't know what inflation is going to do, and until we get that data out, there's no point in trying to preempt. Okay, but this is the key. Don't forget, the tariff rate is going to be closer to the 12.5 than it is going to be to the 30%. The 30%, of course, is if all the reciprocal tariffs were to go into play. That's the number that we would have. Okay, now, if there was a 30% tariff, we know how the markets will react. It is a 12.5% tariff, and we can see how the markets have reacted to that, which is we are at record highs. Okay, make sure you imprint that somewhere. We are at record highs, even though the marginal rate that's accepted by Wall Street is 12.5%. In other words, they are mostly shrugging off the additional 10% as just a little bit of an inflation bump. Okay, now our next topic is, of course, about OPEC. They did exactly as expected. Effectively, they came out with another output hike of 550,000, and ultimately, this is just to unwind the full 2.17 million barrels of output cuts that they had previously. Okay, the point is that they started this year, they came out, they said they are going to unwind it. Of course, there was quite a bit of pressure coming from US President Trump to ultimately bring that supply back to the market. They've done that now. The trajectory was very clear over the last 4 or 5 months, which is bring that supply back. But I think the key takeaway, and we'll get to the chart in a minute, I think the way oil has responded in the overnight is quite important. We'll also talk a little bit about the backwardation. But the key thing to understand from this article, and I think this is the key, it doesn't really matter that they're bringing back the oil supply. We know that was true already from from April, when they started this process and they really outlined for us what they were going to do. I think what is key now is ultimately OPEC plus. Okay, they still have, roughly speaking, 3.66 million barrels per day of voluntary cuts across all the members. In other words, there's still a lot of supply that could come back to the market. Now, we don't yet know what's going to happen with that additional supply. What we do know is that perhaps the OPEC will allow some time now to see what this additional supply does to the market, what prices do. But don't forget, the market still has a lot of additional supply. Okay, that's the key takeaway. What that ultimately means is that should things tighten up, should growth start to accelerate again, they'll be all too happy to bring that supply back. So we're not exactly in a supply constrained environment. I think that's the key takeaway from this article. Now, in terms of the chart, it's an interesting one. I think the first thing to sort of point your eyes to is ultimately what the spread is doing between the front month and a little bit further out. We can see we've been in backwardation for pretty much all the year, but when we had the Iran-Israel escalation, we can see how the market very aggressively went into that backwardation. It of course bounced once the truce was announced, but notice how we've just started to move deeper into backwardation again. I think this really matters a lot because I think it's pointing to an environment that ultimately the market is seeing sufficient demand. Now, there could be a number of reasons for this. We know, of course, we are entering summer season in the Northern Hemisphere, and that does, of course, typically create a little bit of a demand side push for oil, and we've got quite a little bit of similarity ultimately between what we had in 2024. You can see this backwardation started around June month. We had quite a nice little backwardation, quite an aggressive move. Of course, it did top out around the end of the summer month. We can see that oil prices, of course, also topped out at that point. So what does this mean for oil prices? Well, it does mean somewhat of a bid. I do expect over the course of this week we are going to see oil find its way higher. Technically, it's been looking for some reason to move. I think we get that reason now. We, of course, did open in the overnight session with a little bit of a gap. We've retraced that entire gap. I do expect, of course, we're going to take out last week's high pretty quickly. I think if not today, tomorrow, and then I do think we're going to stage some form of a rally and just start to trade up a little bit higher. Where we get to, I don't know. There's pretty much no real levels to lean on. We know that 78, of course, was very key overhead resistance. So if you can ask me for a level, there we go, 78 to the upside. We are going to come in and test this effectively this de-escalation day. So keep an eye on oil. I think that is one to very much be trading over the course of this week. Then in terms of the play of the day and perhaps the play of the next couple of days, it's just in the rate space. So if you were trading the non-farms last week, you would have noticed it was very well received by the rates markets. Okay, the rates markets looked at it as this is a pretty darn strong number. This idea of a July cut is all but dead in the water. Of course, we do have the CPI out next week, which could change that dynamic somewhat. But again, the general consensus now is that we are going to get hot inflation prints given the tariff situation. And so with that in mind, it does seem as though rates are going to continue just to pare back a little bit on this idea of rate cuts, perhaps a little bit closer to what the Fed's thinking, which is one cut this year. Okay, right now we are seeing around 46 basis points, call it 2 full cuts priced in for September and December. But what we can see is ultimately, since that non-farms print, we can see the front or the deck contract or the Fed Fund futures has done about 10 basis points of a bounce. And of course, should we continue this week, should the rates continue just to push up a little bit, ultimately, I wouldn't be surprised to see the dollar track alongside with it. So there is the dollar index. I think it's one to keep an eye on this week. It is where I think the play of the day is. I think it's pretty much looking for just a short-term bounce in the dollar. Now, this is not a medium-term trend change. It's not a long-term trend change. It's very much just looking for a little bit of a squeeze on the shorts. We can see, of course, that the non-farm payrolls on Friday, we did have a little bit of a dollar bid, and we closed as a doji, and we can see that follow through today. Okay, across the board, yen down 0.6, Swiss down 0.4, pound and euro both down. So across the board, we're seeing dollar strength come in, and what I do expect over the course of this week is we're just gonna find our way back up towards that 99.5 level. So keep an eye on it. I do think there's some short-term opportunities to be long of dollar this week, with data being very, very light. It's ultimately going to just come down to technicals. So pay attention to the technicals. It's not something you want to be aggressive with. We do know that the dollar short trade is not an easy trade, okay? But the reality is that the market is very short right now. Rates as of last week are starting to pare back on some of those cuts, and I do think that's going to give some support to the dollar market. All right, and then of course in terms of the week, the calendar is light. What that does mean is the implied moves for equities are light. We do of course have a little bit of vol priced into today because we're getting some letters at 5 p.m. BST, so British summertime, 5 p.m. That's midday Eastern time. We are going to find out about what tariffs are being applied to who. But like I said, it's the kind of volatility where I think the absolute best play is definitely don't want to be chasing it. If anything, you want to be look for short-term dips to ultimately get on with the dip buying process. Okay, I think that is going to be the play this week, is just to look to fade any kind of volatility on the tariff situation. Why? Well, because don't forget, we've got 1 month to get to the 1st of August, and then if the countries are negotiating in good faith, we could have even further extension. Okay, that is the flavor of the day. That is the strategy being applied. So we need to adjust accordingly. With that in mind, we do have 2 US auctions, a little bit longer dated. They will, of course, be watched very closely, but they've been very firm over the last couple of weeks. So not sure there's going to be anything there. So yeah, what that does mean for us as traders is we need to be very selective. We are in summer markets now. We have got low vol conditions, so we have to be quite picky about the trades we take on. If there are any other questions, do post them in the Discord channel. Don't forget to like, subscribe, and share the channel. Do add your comments. I do have a lot of fun answering them. Otherwise, good luck out there today. Manage that risk. Go make some money.